Good evening, and welcome to tonight's market report. Let's start with the closing numbers. The Nasdaq finished at 25,870 points, down 0.84%. The S&P 500 closed at 7,353, down 0.67%. The Dow Jones settled at 49,363, a decline of 0.65%. All three major U.S. indices ended in the red, reflecting a cautious mood across the board. The VIX, often called the fear gauge, edged up to 18.06, signaling that risk aversion is creeping back into the market. Now let's look at the fixed income and currency markets. The 10-year Treasury yield stood at 4.67%. The dollar index came in at 99.31, while the offshore yuan traded around 6.8169 against the dollar. In commodities, WTI crude oil closed at $104.19 a barrel. Spot gold was at $4,484.90 an ounce. So what really happened today? The market experienced what we call a shakeout. Money clearly flowed out of high-valuation U.S. mega-cap tech stocks. Google fell 2.1%. Amazon dropped 2%. But here is the twist. The money didn't just vanish. It moved into cash, dollar assets, and crude oil. And interestingly, Asian markets showed a strong independent streak. China's A shares actually rose for the most part. The Shanghai Composite gained 0.92%, supported by domestic policy expectations and positive news around the country's computing platform initiatives. So Asia did not follow the weakness from Wall Street overnight. In fact, it acted as a regional safe haven. The real turning point today came when U.S. markets opened. The 10-year Treasury yield surged to 4.687% during the session. That spike in rates triggered a wave of selling in tech stocks. Make no mistake, the Treasury yield was the real leader today. It dominated the pricing of risk assets globally. And while China's A shares tried to hold their ground, their rebound was completely ignored by U.S. markets. That tells us something important. Right now, global capital is being priced primarily by U.S. macro liquidity, interest rates, and the dollar. Regional good news is not enough to reverse a broad-based shift in risk appetite. Now let's dive into the sector dynamics. The strongest area today was U.S. optical communication stocks. Astra Labs surged 13.3%. Credo Technology rose 8.14%. On the flip side, large-cap tech stocks were the weakest. Google fell, Amazon fell. What does this tell us? It tells us that within the AI theme, there is a clear rotation happening. Money is moving out of the expensive, interest rate-sensitive AI application layer and into hardware infrastructure. These are the companies that benefit from AI capital spending, the so-called pick-and-shovel plays. This structural signal is very important and we need to watch it closely. Looking ahead to tomorrow, shares are likely to open lower. But whether they can stage an independent rally depends on how strong the domestic policy response is. If the 10-year yield continues to climb above 4.75%, global markets could face further pressure. However, if the yield stabilizes between 4.6 and 4.7%, then there may be a buying opportunity in China's computing and hardware sectors, especially if they are oversold on fear. Let me be clear. This is not a market collapse. It is a structural rotation. Our strategy is to be cautiously long. That means selectively adding positions in sectors with clear logic and that have been unfairly sold off. But we are not blindly bullish. If the Nasdaq 100 breaks below 25,500 points, or if the VIX surges above 20, we will exit all long positions immediately. In summary, today's market was driven by interest rates. The bond market is the boss right now. The rotation from software to hardware within AI is real. And Asia, particularly China, is showing resilience. But the key variable remains the 10-year yield. Watch it closely. That is your signal. Thank you for watching. We will see you tomorrow.